now the universal sign everywhere around the world. To begin, you could also say, I guess, it's the use of OK, which I have encountered in every country I have ever been, is a real indicator of our, no one's dead, is a real indicator of our global world these days. It actually comes, we think, and I've actually tried to look it up, from a 19th century American election campaign. Martin Van Buren, who was from New York, was known on the campaign trail as Old Kinderhook, which is a Dutch name, because obviously the Dutch settled New York first. And it is thought that OK was used as a campaign slogan for Martin Van Buren in the early part of the 19th century, and it has come down now to be the pretty much worldwide universal for everything is okay or yes, basically. Anyway, that's just an aside. Yes, it is a lot easier to say than "oh, kinder" something. That is certainly true. Again, as always, if anyone has any questions, please ask them during the session. I'll be glad to answer them. I'm going to move across a number of topics today and a number of markets. But I always like to make these sessions as, even though I don't like the word very much, as interactive as possible. When I give lectures and presentations in person, I like to do the same thing. I think it makes the presentation much more interesting rather than having my lecture for an hour or so. And it is good for me because I learn things from what people ask and where their interests are. And many times people come up with things that I had never thought of. So all in all, I think it's pretty good. The beginning of our topic, or at least the beginning of my interest in this, and people who have been to these lectures, these webinars, and have read some of my commentary over the past couple of years, certainly since the markets have resumed their non-panic trading, if you will, since at least the currency markets and the other markets as well, since March, has been my interest when what I consider a very illogical approach to the currencies, being the dollar risk trade, will fade, and we will return to more historical, and one might say traditional, methods of generating movement and volatility in the currencies. It is, I feel, an unusual situation and one that cannot last forever, where the dollar, as a representative, if you will, in the world currency markets and the world in general, of the American economy, trades in opposition to economic logic. And the dollar risk trade absolutely does that. You can say that it's in, as I have said, that it's in opposition to economic logic. Of course, you can look at it another way, and that is that it is simply that economic logic is overpowered by fear logic. The fear logic, of course, stemming from the great collapse last year and into this year, in which anyone and everyone, it seemed, kept dollars in opposed to almost everything else, because at least they thought the U.S. is less likely to disappear and blow up. As we've seen since then, we're not so sure that's the case. But at any rate, the residue of that trade has a very powerful psychological factor, because it certainly was true at the time, and I don't think anyone believes that the world economy is on a stable basis right now. It seems quite fragile, and there are certainly many markets and considerations out there for worry, and that will keep the dollar risk trade in the back of everyone's mind. In addition, we of course have the very reliable trading factor. That is, as we all know as traders, if something works, you keep doing it until it stops working. And it's hard enough to figure out which way markets are going to go. And if the risk trade produces trading profits, it will continue to produce trading profits. So those two reasons are very strong for keeping the risk trade in place. And it has been in place, although I think with a diminishing degree of force, ever since March. I'll get to that SDR in a minute. The questions about the dollar. I know we had some people on the site are having a discussion about dollars and what could be used with as a replacement for the U.S. dollar. So, but that's a little bit off the topic today. But I'll be glad to deal with it in a bit. Unless you guys who were talking about it, whom names I recognize actually from many of my other webinars, are simply talking amongst each other, in which case I will not answer, but you can let me know what you want to do. There have been quite a few instances over the past 6 or 8 months where you get good news in the dollar, and you get good economic news in the dollar, and you actually get a positive reaction in the dollar. That is the linkage that I'm looking at. I can probably turn the volume up here or turn my voice up here if I'm seeing that. So we said the volume is low. I can turn up the microphone volume. Let me know if that's better. I turned it up about 20%. Okay, so we have seen a number of reactions in the markets, in the currency markets over the past 6 months where the dollar actually responds to good economic news or bad economic news in the United States in a historical fashion. So good news, the dollar goes up, bad news, the dollar goes down. One of the things that happened, or that was true of most of those instances, were that the other markets simply did not respond in the same fashion. In other words, if the dollar was improving because economic news was good, you had perhaps the stock market falling, or you had the bond markets or the gold market doing something that didn't seem connected to the economic news that was coming out of the United States. It would seem that when the reactions of these different markets lines up, I mean, they all respond within their own fashion to the same type of economic logic, then we're getting closer, I feel, to a return, and I've spoken about this topic, as I've said before, to a return to the type of economic logic which makes logical sense, that is not dominated by fear. I think we had some of that cross-market, I won't call it pollination, but cross-market reaction to the non-farm payrolls on Friday. And I'm going to go through that a little bit right now. On Friday, of course, we know, last Friday, not this coming Friday, I don't live backwards in time like Merlin, although sometimes I'd like to. If you want to live backwards in time, you should have children. I had 2 twins who were 15 months old, and they change so quickly that they make me feel like I'm living backward in time sometimes. Anyway, that's a different topic. On Friday, of course, we all know the non-farm payroll was much better than expected. A slight aside on this non-farm payroll, and I'm going to go into it on the markets, on what the reaction I saw in the markets, and I think we may be reaching finally a turning point in what the markets are paying attention to and how they're reacting to economic news. Last year, actually it was this past January, the numbers that came out in early February covering the prior year, covering 2008. Now, if you look on the numbers for non-farm payrolls, the most jobs were lost in January. Now, there is a statistical revision that the BLS does every year. And I'm going to try and explain it. I'm not a statistician. But there is a very credible chance that this January, when the numbers are out on February 4th, you're going to have the same type of revision. Now, if we remember last January, no, I did not say manipulation. This is not manipulation. This is not a statistical, this is something that's inherent, as I understand it, to the statistical tools that the BLS uses to estimate new jobs. It is not something that I give any credit or any blame for it being political. Happened under Bush, happened under Obama. It is something that is part of the statistical paradigm that the BLS uses, not connected to politics. But if we remember last year, what they call the birth-death revision that they do once a year, and I'll explain it as far as I understand it. I did take statistics in grad school, but that was some years ago. Although it's an absolutely fascinating topic, or as Mark Twain said, lies, damn lies, and statistics. Yeah, well, let me tell you how my understanding is. Somebody has a comment on there about it. I guess you guys can't see it. About the birth-death revision. Anyway, last year's birth-death revision brought out, dropped the number of jobs that the economy had, that the BLS had estimated were created in 2009 by, if I remember, about 840,000. That's a large amount of jobs that were simply never existed, but had been calculated into the monthly statistics all the way every month coming out in 2008. The reason this takes place is because of the survey that the BLS uses is a voluntary survey. Everybody doesn't always respond to it. Some of the companies that have received or that are supposed to receive it either don't respond to it or actually have gone out of business. So the BLS doesn't get any responses back. In addition, they assume that during this entire period, or any period, jobs are being created by companies that are forming, which the BLS doesn't know about. So they make an estimate for the number of companies that are being created and are creating jobs. The basis of this estimate, the numbers of jobs and companies that are being created, is one which has an historical basis. It had always worked with a pretty good approximation in the years prior to 2008. 2008, we ended up in a very unusual economic situation, the type of situation that has continued very much into 2009. We had a financially led recession. Financial recessions from financial crises behave very differently. There's a good book which I just ordered by Kenneth Rogoff and Carmen on why and historically about how financial recessions work very differently. The recovery is much slower. But anyway, so the BLS statistical estimate that they had used based on historical fact before 2008 didn't work in 2008. Yes, that's correct. New companies are open and hire, but because the BLS doesn't know about them, they have to estimate them. Then they come up with a survey, and I don't know how they actually contact them, maybe through taxes, maybe you're right, because they are registered. They can go back and then look at, I guess, collate with other government bureaucracies which have the new registration for the companies. They can go back and then check and see how these new companies, how many there are, and how many people they've hired. So they can then check their estimates. Their estimates had always worked. I had a long discussion with this with our resident statistician here, who actually has a degree in physics from MIT. So I do trust his interpretation of these things. In prior years, they had always gone back, and the estimates that they had put in, creating jobs, which they add into the jobs numbers. So when you see a number, say, for 11,000 in November, that includes, say, 150,000 jobs that the BLS estimates were created in that month. Obviously, you put them all together, you end up with 11,000. If that number's not 11,000, if that number's not 150, as an example that I'm making up, it was 0, then you actually lost 161,000 jobs in November rather than only 11,000. As I said, that statistical method had always worked before. It didn't work so well in 2008. And the judgment of people who are familiar with this is that number, that type of estimation is not going to work also in 2009. That means when the birth-death revision, this is what they call it, birth and death of companies is what they mean, comes out, the once-a-year revision comes out in January for 2008, for 2009, I'm sorry, but it's released with the January non-farm payroll numbers, the employment situation that's actually called, in early February, taking care of the changes, the revisions to 2009. You could very well get another number as you received for 2008. Several, probably close to 1 million, 100,000 jobs, so say 800,000 or 900,000 jobs, as in 2008, simply will disappear. They will apportion it, I don't know exactly how they do it, across all of the prior months, and you end up with a very different employment picture than is likely, than people feel is true now, with the non-farm payroll number of job losses declining at a very, very nice curve throughout 2009. So, for your estimates, and as we know, politically and in the media, the unemployment rate and the non-farm payrolls are dominating the unemployment news, the economic news. That is what people are paying attention to. So for all of you who are watching the economy and making your judgments about what is going on, what the prognosis is for the employment picture, be aware of this potential revision that will be coming out with the non-farm payrolls, I believe, on February 4th. It could be a quite substantial shock to some of the estimates that are out there in the economic media. People who have been around the markets for a long time are aware of this. But again, last year was really the first year that I remember where there was this substantial revision to birth-death. Now, as I said, I'm not a statistician, and I've been doing this for a number of years, so I don't guarantee that it's like that all the way back. But it's something to keep in mind when we are recalibrating our estimates for what's going to happen economically in the United States and the rest of the world in the new year in 2010. So back to what we saw on Friday, and whether or not this is, yes, that's right, first guess, then revised. That is true. But as Mark Twain said, lies, damned lies, and statistics in escalating order of heinousness as crimes. At any rate, Mark Twain is always good for humor if you ever get a little bit depressed. He really is very funny. So on Friday, oops, this one moved away here. On Friday, we had a very unexpected non-farm payrolls, a good number by any measure of the United States economy, certainly considering what had gone on before. So this is what we saw in the three markets I had up here. These top two, the yen and the gold, are, I believe, 4-hourly charts, and the euro below is a daily chart. But we do get the same type of information out of it. The daily chart for the hourly chart for the euro was going to take too much time to bring up, so I didn't bring it up. But let's take a look at it. So this is the 4-hourly in the yen. You can see what happened. This is the 4th. This 4-hourly encompasses the release at 8:30, and you had, over that time, almost a 3-figure run-up in the yen in a couple hours. Same thing happened in the gold, except in the reverse. Now, the gold actually peaked out the day before on the 3rd at $12.25 as record price. So on the 4th, we had this fall right here, almost $80, $79 if I remember correctly on the numbers. So both of these, in these two currencies, and let's look at the euro as well. The daily chart in the euro we have here covers the daily. We had a drop from 50.89 to 48.50, more than 2 figures. Actually, top to bottom, it's almost 250 points. All of these reactions are the normal equation between an expanding economy, or an improving economy, shall we say, and the dollar. When you get an unexpected number, as we did with non-farm payrolls, much better than expected, you would expect the dollar to benefit. And in these two currencies that I have up here, the dollar indexed the same way. The DXY went up, I think, 1.7% on the day. So in these markets, you did see what is the reverse of the risk trade that we've been seeing. The risk trade that we've been seeing for 10 months now is you get good statistics in the U.S., people are less worried about risk, and they sell the dollar and buy something else. They go into trade, they go into a different currency as far as the currency markets go. One that is supposedly returning better, or has a better potential for appreciation, or they're investing in a foreign market. Whatever it is, they end up selling dollars. That's the standard trade we've been seeing for 10 months. On Friday, we did not get that. So we have two questions, I guess, to ask. One, is this permanent? And two, is there some other particular reason that may have been operating on Friday that does not mean that the markets have decided or are returning to economic valuation, fundamental valuation, if you will, but something else might simply have taken place there. We can also look at the Treasury market, which I believe I have here. Yes, this is the 10-year government index. This is not really as indicative, but I like to use it as well because what really drives the economic fundamental equation between economic growth and a rising currency is, of course, that it runs through the interest rate cycle of the central bank. And it's cliche in the markets, of course, but we all know it's true. Rising economic growth ends up producing inflation. Sooner or later, the central bank will probably start raising rates, and markets simply anticipate as soon as that seems that it will be the result, regardless really of how far in the future it will be. And you've seen now the 10-year Treasury yield had been rising actually from 3.198, which is almost the low since March. Almost, not entirely, not quite. There are other lows up here in the beginning. Has been rising since the 30th. It actually reversed on the 4th. Went down a little bit, and then now it has come right back up to where it was at the peak on the 4th. So that move is the move from the 30th on up is indicative of a returning economy running through interest rates. Prices in the Treasuries go down, interest yields rise. Now, when we look at a longer-term chart in the Treasuries, which I know I've spoken about this before, but I just want to show it to you here. Let's look at a weekly 10-year in the Treasury. This is on Bloomberg, actually. You can see that where we are now is in the Treasuries is a product of a long-term trend going back to the early part of this decade, actually, going down because central banks have been much more successful in targeting interest rates. In targeting inflation, which produces lower interest rates. This is the fall here, of course, after the great crash last year. So all we've really done is return to that downtrend. There's nothing indicative about this particular rate, although I feel, given that the amount of liquidity that's been pushed out into the system, that without the Fed's very deliberate support of Treasury prices, we would probably have this rate much closer to 4% or even higher, which would be a lot closer to the historical norm for the Treasuries, especially considering the amount of liquidity that's out there than we're seeing now. But let me just return to the daily for a second. Oops. Daily 3 months. Oops, that's not the right one. This is the first time I've ever had a Bloomberg terminal, and I live in New York. I will tell you that I'm not doing an ad for Bloomberg or anything else, but it is a very impressive system. And I can see why, if you do financial statistics, you really simply can't do without it. It's pretty interesting. Okay, so this is the 10-year Treasury. Okay, so where are we? We have three markets responding, and I didn't cover gold. Now, you can look at gold in two ways, but either way it produces the result that we saw. Of course, gold is priced in dollars, so if you get a stronger dollar, you're going to get a natural fall in price. The equation doesn't actually work, meaning that it's not one for one. A 10% rise in one doesn't produce an equivalent 10% rise in the other. Nevertheless, you do get, somebody is waving from outside my window, you do get a reverse in the gold price, obviously, when the dollar goes. You also get a reversion in the gold price because of one of the other groups that certainly trades gold, is the group that's worried about the economic future, Armageddon, whatever you want to call it, the end of the world group. And if the U.S. is recovering, then it's farther from Armageddon, so is the world. Therefore, the reason for holding gold as a hedge against future catastrophe is somewhat diminished. So both of the reasons would play into it. But nevertheless, it's the natural reaction. It is the type of reaction you would expect from the equation between better U.S. statistics, feeding through to higher interest rates, stronger dollar, less worry in the world. It's not quite so clear that that is going on in the Treasuries, because the Treasuries, the interest rates, which it would be higher interest rates, if you get a stronger U.S. economy, you would naturally expect the 10-year rate to rise and the price to fall. Now, that had been going on since the 30th, as I said. So you can at least make the argument that the Treasuries also are responding to the anticipation of a better U.S. jobs picture, which, of course, is a better U.S. economy, since that's what everybody's paying attention to right now. And that is also the standard type of reaction that a non-manipulated Treasury market would have. I say manipulated because the Fed very much is manipulating the interest rate market in the United States, both deliberately, directly. Certainly the support program is not in the Treasury program, although I believe that program has not expired yet. I'd have to check to see how much they're actually still buying. The $300 billion that was announced back in March 18th. I know I had one of my prior webinars, I pointed out that particular day when they announced that monetization of the debt, the $300 billion Treasury purchase by the Fed, the euro fell more that day than I think any other day. I'd have to check in history, but certainly in 10 years. So that was a real check, potentially, on what the Fed was up to, and I think they recognized it. Nevertheless, the response that we've seen, even within this manipulated market, is a normal economic response. Now, what else do we have? And of course, it's a rhetorical question because I'm about to answer it. What else do we have that's operating right now that could account for these particular moves without necessarily meaning that we're returning to standard, traditional, economic, fundamental, currency, cause and effect, and measurement? Since it's rhetorical, I won't be coy about it. It's obviously December. Everybody remembers what happened last year in December. Let's take a look at the euro last year. Make this euro chart a little bigger. And we'll bring it in. And this right here is last December. Let's look at what happened before. The economic crisis, which sponsored the financial crisis and everything that was going on last year, that drove everybody to the dollar, didn't abate over December, over the Christmas and New Year's holidays. In fact, it kept running until March, when it finally turned around and we started to get some movement the other way. We started to get a bit of a slackening of the fear that was in the market. So what was this? Well, it's simply December's thin markets and profit taking. Let's don't forget where the euro had fallen from. The euro had fallen from, back in July, up at 160. So this is the obvious potential answer for what we're seeing in the move that we saw on Friday. To look at it again, and I'm not sure that it's not the case. But let's take a look again and see where we were. Okay, let me move it back here. Okay, so this move and this move in the gold and here. If we close in the charts, we all know what gold's been doing. We all know what the dollar yen's been doing. I mean, I've had a number of discussions with various reporters over the past 2 weeks, and they all want to know, why is dollar yen at 84? was it when it was down at 84? Why is it at 85? The Japanese economy has been in the tank, well, not quite in the tank, but it performed extremely poorly for 10 years. It's still performing poorly. Japanese interest rates have been zero or close to zero for nigh on 10 years. The stock market is below, way below what it was at its peak. And it's never come even close to getting back to that 38,000 peak as the Nikkei from the late 80s. That's 20 years ago. They're all calling me up, not all of them. Many are calling me and saying, what can you explain? How can you explain this? The explanation I give is because the yen ended up here from a residue of the unwinding of 6 or 8 years of carry trade. And by the time it got to its level, there was no other direction to push it. Meaning, there was nothing else that could drive the currency in any particular direction, except the weakness of the dollar. It simply started from an irrational, if you will, starting point, and then everybody starts over. So now when the yen goes down to 90, and you can make any comparison you'd like, and then the yen doesn't belong here. The U.S. economy has much greater flexibility. It's not just against the dollar. It's not nearly so tied to exports. The U.S. has a history of a much more flexible labor market. I mean, on and on and on. If you're looking for economic reasons why the yen should be weaker, at least against the dollar, they're all true. But the focus since March has been on the increasing weakness of the dollar. So even though the comparison between the yen and the dollar should be very much to the dollar's benefit, if the dollar is weak and weakening against everything else, it ends up weakening against the yen as well. In addition, of course, whenever you get greater risk, or whatever it is you want to call it, in the markets, people sell the yen crosses. When you sell the yen crosses, you end up selling dollar yen. You end up because you're selling yen, you're selling euro, buying yen, selling dollars against the yen, you end up weakening the dollar against the yen as well. It doesn't make a lot of economic sense, but it makes a great deal of trading sense. So when you were where the yen was just before December, was at 15-year highs, or the dollar to 15-year lows against the dollar. If you take the view that I do to some degree, that what happens in December, as the cliche about Vegas is, stays in Vegas, what happens in December tends to stay in December. It does not usually indicate the advent of any type of new trend in the currency markets. I wrote a column last year, which maybe I'll reprise this year, in last December, that took a look at the movement in some of the major currencies in December and how many of them actually were indicative of a new trend leading into the new year, and almost none of them were. As you can see in euro, which is the best example, of course, we came hard down in the euro, which was unrealistic here in the first place in July, to November. Took out more than the 61% Fibonacci from the entire fall from July until late October, the crisis fall, at least this section right here. We took out a 61% Fibonacci on the way back. That is pure profit taking, in my opinion. And stops on the way down, because everybody who's short here is going to leave their stops. They're not going to forget about them during the Christmas holidays. And when there's no liquidity and no one is taking new positions, we all know what happens to the stops. They are found. That's a natural function of the markets. And then, of course, we went right back down almost to the bottom after that. So you reversed the December move. It was not indicative of this here, which has an entirely different scenario. This is pure profit taking. So are we in that type of scenario here, where this move and this move and this move are really only indicative of profit taking and not in the indicative of a return, as I like to say, to traditional economic and currency comparisons? I would say that we probably have, and this is going to be a real hedge on this one, sorry about that, a 50-50 logical approximation here. There is no doubt in my mind that a lot of this, especially in the gold, but also in the currencies, a lot of this move, at certainly the triggers, is profit taking. It is a natural function of where the markets are at the end of the year, heading into the 2 weeks at the end of the year where there is very, very little liquidity in the currency markets. It is a natural function. If you've got profits to take, then you better put your stops in and make sure that they are taken, otherwise you'll be blown out. Now, if we look at the timing on these moves in December last year, the big moves took place almost at the beginning of the last 2 weeks of the year. This one's on the 11th, then we are the 12th, and here we've got the 15th, and some of this craziness right here, a lot of craziness, took place, most of it took place during the last 2 weeks of the year, right? All this up and down gyrations. That's exactly what you'd expect. We're not in the last 2 weeks of the year. These moves were much more limited, and they took place on the 4th. There's still a fair amount of liquidity running around on the 4th. It really is the last 2 weeks of the year, and nowadays where banks really withdraw from the market and really don't take a lot of new positions. So you have that factor. You also have that there hasn't been a huge amount of follow-through on this. Okay? The yen made it up to 90, but now it's all the way back at 88.21. The gold has continued. Now, gold I would expect to continue because there is a huge amount of speculative profits encased in the gold price to where it is right now. So gold, I would expect that the gold would continue with this move, and I don't think that is so much of I think the gold is primarily a trading move because of the nature of gold and how much speculative interest there is in gold right now. What do I say about stops during the holiday? Because the markets are much, much thinner during the market, there's much less liquidity, the bank traders who are watching stops. Now, remember the way bank traders work. And I was a bank trader for 15 years. You're sitting watching a book. You're watching the markets. You have the market is trading, 30.35, 30.33 in the euro. You've got a stop on the upside for one of your customers who wants to buy 100 million euro at 60. The market starts to creep up. You're responsible for executing that order at the best possible rate. Because it's a customer, you can't really take many points. So if you fill the order, instead of at 60, it's 70, because you waited until it actually went through, that 10-point loss is yours as the trader. You can't write it to the customer. So what traders have a tendency to do is judge the risk in the market. They also will look at their charts and they'll say, okay, I have a customer with a stop at 60. Is that a logical place? Is this just some outlier customer whose interpretation of the market is completely unique and only his own? Or looking at the charts, looking at what I know about some of the resistance support level, the way the market has traded over the past 2 weeks or wherever it has been, is this a likely level for lots of other stops in other banks? Because after all, as a bank trader, you don't know what's in the market. There's no NASDAQ level 2. You only know what's on your own books. So if your judgment is, as the trader, responsible for executing this order and also responsible for your own P&L, bank traders who habitually lose money get fired. Your job is to actually make money. If your judgment is that this is a likely stop level, that it's not only you who's sitting on a $100 million stop 30 points away at 60, but it's a very likely place for everybody else, then you know that once it starts getting close to that, the market is going to accelerate into the stop because everybody's going to start buying ahead of their stops, because when it goes through, they want to protect themselves so they're not filling their own book, giving to the customer and taking that large loss. 10 points on $100 million is a lot of P&L. I'll actually track it. It is $100,000 That is a lot of P&L, tremendous amount of P&L for a trader in one day at a loss. So this is why markets tend, as a general rule, to look for stops when there's low liquidity, because the traders who are watching all the stops will buy ahead of the stop because their judgment is that it's going to go through. Now, of course, the risk they take is that it doesn't go through, and this happens many times. So if you're a bank trader and you have $100 million and it's now 50.53, your stop's at 60, you buy $30, 30 euro, 40 euro in anticipation of the stop running through at 60, and somebody comes in and starts selling, or there's a big order there, or the ECB, Trichet, announces we're never going to raise rates again, and the euro starts collapsing, you own those 30 or 40 euro at 53, and you've got to do your best to sell them. So there's considerable amount of risk on both sides. But when you ask, what do I say about stops during holidays, because there's so much less liquidity out there, because there are so many fewer people buying or selling on the other side of these things, because the bank traders who are watching the stops have far fewer people to call to actually get the liquidity in that they need to execute the order, markets have a tendency to run much more than they would in normal markets, with normal liquidity. And that's why we see this type of reaction right here. I mean, this is 1, 2, 3, 4, basically 5 days, 5 or 6 days, 1 week of trading, and you've got the market going from 29.02 to 44.5. That's a pretty good move in a week, and it's because of the lack of liquidity. So there's a definite possibility that you can see that kind of movement. There's always that kind of potential. When you say such thing as stop hunting, no. By any of the FCMs, ourselves, or any of the other market makers, no, we don't. The prices don't come from us. The prices come in from the interbank market. We have a direct connection to the EBS market. In fact, the company that owns EBS, ICAP, also owns us through one other company in between. So our prices come in from the outside. We have nothing to do with generating prices. So in that sense, yes, the bank traders who generate the prices, because remember, EBS is a voluntary price submission system. The guys on the bank desks and Reuters, the other systems, they sit there and they submit prices to the market. So that is where the prices come from, that come through our system right here. So in that sense, yes, I mean, bank traders don't actually hunt for stops, but they do trade in a fashion that has to protect both themselves as best they can in their P&L and the customer whose orders they're executing. So back briefly to the idea of the December moves that we're seeing here, and whether it is really indicative of a large of a change in the market's view and connection between whether we're losing the dollar risk trade. I think to some degree we are. And what will I back this up by saying? The moves that we're seeing haven't continued, meaning the gold, as I said, the gold I think is kind of outside this particular analysis because of the very large, it's huge move over the past year and a half, so that there's just so much potential there for profit taking, and that's why people are trading it as a hedge, that you're going to get, I think, a continual move in that direction. And you're seeing that in the gold since then. The interesting thing about the the euro, is that the euro has continued in its direction. The yen reversed. What do we make of this? If it is a reassertion to some degree of the economic determinants that we're used to, then you would expect, and it's not simply an indicator of the profit taking in the euro or the other currencies. I mean, this particular run, if you compare it here to what you've seen before, this really doesn't give you a sense of a huge generated stop run by people looking to make lock in profits. It does seem to be somewhat, at least, a change in attitude for the dollar and the euro, and perhaps for the U.S. economy and the European economy, prospects for U.S. interest rates, all of the other things that go with it. Even though Mr. Bernanke was out again on Monday saying that we're going to keep rates low for a long time, I think maybe the markets are starting not to quite believe that as much. Certainly, if they're trading lower in the bond market and they're trading higher in the dollar based on good economic news, that is discounting to some degree what Mr. Bernanke has been saying, or at least the markets no longer believe it as surely as they did before. The interesting thing in the in the yen, is that you haven't seen a continuation of the movement higher as for the dollar that you did in the euro. The euro has continued on in dollar strength. The yen has come more completely back to where that run on the 4th started. Started at the low was 88.29. We're now at 88.17. It's right back to where it was. So these two don't really agree with the idea of dollar strength, unless, of course, you bring in the euro yen. I think that what's been going on in the yen, as I said before, has only really to do with what's been going on in the euro yen and its reactions. Because there really isn't a lot to choose for the yen in its current state. Yet you continually get a dismal Japanese economy, you get a strengthening dollar yen. Does this make any sense? It doesn't. Even when you get a move higher in the dollar, as you've seen in the euro, you end up with a move lower in dollar yen. I think what's happening is that the natural equation that you would find between the dollar yen and the euro dollar, where the euro yen stays stable because it's a dollar move, and you get the equal proportionally changes in the US dollar against the yen and the US dollar against the euro. You're not seeing that because the speculative interest, the volume, is going through euro yen. And so when you get a euro move, you get a equal euro yen move, which simply determines where the dollar yen is. These two charts don't make a lot of sense unless these two moves. Let's try and get this one a little bigger here. I can't. Let me do it a little bit here. Okay. These are the two moves. They don't make a lot of sense unless you explain them, and it's the only thing that makes any sense, by the moves in the yen crosses. It makes no sense for the euro to be depreciating against the dollar while the yen appreciates against the same dollar. So you've got to keep this in mind. And this is one of the things I try to explain to various reporters and journalists, and it doesn't translate well into a cause and effect for the people who are writing the columns. But you have to keep that in mind. So don't let this one puzzle you when it comes to a reaction on the dollar. This one is explained by the dominance of the euro yen in market interest. That's what people trade. That's why you end up with a currency like this. So let me look at some of these questions here. So back to my final point, and then I'll answer some of these questions. I think we are seeing a return to gradually. And I think these numbers actually, and what struck me was that all of the markets moved at the same time. These different markets went in the same direction at the same time with a normal or a more hysterical, yes, I'll finish 2 minutes, let me ask some of these questions, with a more traditional way, a more economic way, a more fundamental way of comparing currencies through fundamentals, interest rates, and economics. So I think we are seeing a portion. This is not purely, in my view, a profit-taking reaction to December and to the end of the year, although there is undoubtedly that factor to it. I can't assign percentages to it. It just is my interpretation of the way I saw the markets move on Friday. So let me look at some of these numbers. We covered, the questions. there, that question, are we going to have a December to January last year in euro? I think we'll have some profit taking naturally. I mean, at the end of the year, if you're going to have profits, you put in a stop to make sure you keep those profits. I just don't think you're going to get the same degree that you saw in it last year. And one of the reasons is because you haven't had the same type of move that you saw. Last year's move from July till December, November was pretty much historic. We all lived through it. We can all tell people about it. Those were wild markets. And so the amount of move determines the amount of reaction. And so I don't think we're going to get the same thing. What tool do you use to gauge the strength or weakness of a move? That's a good question. The more rapid a move, the more I lay it to stops clustered around either a resistance level or a very prominent chart formation. Unless you're in a situation like you were last year, where the unusualness and the degree of the move also determined the reaction. In general, what I look for as far as determining where retracements go are really the Fibonacci levels. I don't think they have any inherent value, but I think since all markets like this are profit markets, that they do describe a very accurate picture of where people will go to when it comes to the amount of profits and the likelihood that they will take. When it comes to Fibonacci moves, I put them on the daily charts only. I don't think they really apply, because they're definitely long-term moves. I don't think they apply very accurately to shorter levels, because there's not enough. The more volume that you have involved in a Fibonacci, the better indicator it is. And that's true of other indicators as well, of course. How can I use the indexes, USD, yen, to make better trading decisions? It's a good question. I'm not sure exactly what the answer would be. I view interpretations of the markets as sort of a psychological self-fulfillment loop, where if you look at the formations on the charts and the indicators, the more people, the more indexes, the more indicators, the more chart formations, the more time frames that line up with agreement, the more likely you have. It's as if imagine that each indicator had its own fan group that only traded that indicator and used it to determine its trading decisions. Well, then the more fan groups you have involved, the greater portion of the market you're going to have involved in any move, the greater chance you have of it having to take place. Yes, orders do have a tendency to gather around round and semi-round numbers. There's no doubt about that. I think I'm getting shut off here. Do I think the dollar rebound is just profit taking? No, as I said, I think there is a certain degree, I'm not sure how much, but a certain degree of reversion to economic statistics and ebbing of the fear and risk trade that has been prompting the dollar's weakness since March. Yes, I'm afraid that's it for the questions. I thank you all for coming. I hope it was instructive and perhaps a little bit informative. And we will see you, I guess, in January. Everyone have a good holiday wherever you are in the world and wherever the holiday is. Take care. Thank you very much.